Alright, hello everyone. Today we are going to be doing a follow-up on the previous video that I did. Today we're going to be doing a paper LBO, something really basic, especially in comparison with the last video that I uploaded, with like kind of a full three-statement build-out, stuff like that. So kind of going to be really simple. Going to have just kind of a approximation for the IRR, no real debt schedule build-out, but yeah, get right into it. So starting off with our transaction assumptions, we've had LTM revenue of 1,000, LTM EBITDA of 500, with an assumed entry and exit multiple of 10 times. We're assuming that it's going to be financed with kind of one tranche of debt, and that's going to be raised at 5 times EBITDA, carrying a 10% interest rate. Then for our margin, we're going to assume that our EBITDA margin remains unchanged at 50%, with DNA as a percentage of revenue being 10%, CapEx being 10%, and then with a 5% change in net working capital. So first thing, we can kind of jump in. I'll just lay out some base formatting for the sheet. This quick little basic formatting, and we'll hop right into it. There we go. Okay. So first things first, this will be our paper LBO. Just like that. So the first thing that we're going to do, same as last time, is going to be the laying out of our transaction assumptions. So I guess maybe it'd be helpful to look at what kind of the actual steps are going to be. So the first thing that we'll do is we'll have our transaction assumptions. And this can include the entry valuation or kind of be the second step. We'll end up doing it as kind of a separate second step underneath. Then we'll have our sources and uses, same as always. Then we'll have our free cash flow projection. And so this could be as simple as starting with revenue and building all the way down to free cash flow. What we're going to do instead, just to give some more clarity, you can do income statement, and then we'll also do a free cash flow calculation underneath. But you could theoretically combine these steps, and especially if you're doing it on paper, it can be helpful to calculate directly to free cash flow as opposed to doing kind of a full income statement. But we'll build that out here just so you have a sense of what's going on. And then our last thing is kind of be this returns analysis. So there you go. This is kind of broadly speaking what it's going to look like. And yeah, let's jump right into it. So first thing, transaction assumptions. And so these will be heavily simplified, especially in comparison to some of the longer length, legitimate kind of full model tests that you'll have to do. So we'll have our entry multiple, we'll have our exit multiple, we will have our LTM EBITDA, then we'll also have our kind of financing assumptions. So we'll have our leverage, it's going to be times EBITDA, and we'll also have our interest rate on debt. So starting with our entry multiple, entry and exit multiple, we're going to have 10 and 10. So we'll put in 10, with our LTM EBITDA being 500. And then we are raising 5 times of debt at a 10% rate. We'll put in some basic formatting here just so it's a little bit clearer in terms of what's going on. Typically what you'll see is for these paper LBOs, you really only have one tranche of debt, and it really is like a super simplified version. So now that we have our transaction assumptions laid out, next thing we're going to look at is our entry valuation. This is going to be the exact same as any other LBO, so it'll be your LTM EBITDA times your entry multiple. So what this will get us is our purchase price, kind of the enterprise value, the value of the entirety of the company that we're acquiring. So our LTM EBITDA is going to be 500. We're going to enter at 10 times, paste over this formatting just so it's a little bit clearer, meaning that our purchase price is going to be 5,000. So 5,000 will be the purchase price. Next thing that we'll do after we have our entry valuation laid out is our sources and uses. And so the key thing to note here is that your sources always have to be equal to your uses, and the plug, or kind of the number that's going to fill everything in, or be the last kind of dollar amounts rounded out, is going to be your equity contribution. So we'll start on the sources side. And the two sources here are going to be our equity contribution and then also our debt. So that'll get us to our total sources. And so we know for our debt that our debt was raised at 5 times of our 500. So we can do our 500 for our LTM EBITDA times our leverage, which is going to get us 2,500. Then we can move on over to the uses side. And so there's only going to be one use here. We won't have any complicated management role or financing fees, cash to balance sheet, really basic. All we're going to have here is our purchase price. So our purchase price is going to be equal to that 5,000. which means our total uses are going to be equal to 5,000. And like I said earlier, we know that our total sources have to be equal to our total uses. So we'll link that over, meaning our equity contribution is just going to be the difference between the total sources and whatever we've already raised. So in this case, because it's raised at 5 times and we entered at 10, we're going to have a balance between the equity and debt in terms of how much they're going to be contributed. Now that we have our sources and uses situated, we're going to move on to our kind of brief income statement, starting with our revenue. And so there's kind of two different schools of philosophy in terms of how you can lay out your operating assumptions. You can either do it directly underneath each line item, which is what we'll do here, so it'll be our growth rate, or you can do it all the way at the bottom and do your operating assumptions and then lay out operating assumptions, and then you can lay out everything here and then link up to it. But in this case, we're just going to do everything directly underneath. So we know that for our, I should do this, put in some formatting just so we can see what year we're at. So it'll be year 0, just like that. So we know that for year 0, we had LTM revenue of 1,000. So we'll put that in. And so then the other kind of line items that we're going to see here is going to be our EBITDA. We're going to have our percent margin, which in this case is going to be the 50, so it'll stay the same. We'll subtract out our DNA. Look at our percent DNA, and when something's written down as percent, like percent DNA, all it's really meaning is as what percent of revenue. That's kind of like the base assumption. If it's percent X or gross margin or percent margin, it's always as a percentage of revenue. So here we have our DNA, which will get us to our EBIT. We'll put in our margin here too. Italicize all of these. Then after EBIT, we'll take out our interest expense. And so we're going to calculate that up there. We'll have our EBT. We can include the margin here, just as we've been doing it. And then the last thing we'll have is our taxes. And we'll do tax rate. So the end result of all of this is going to be our net income. Just kind of format out here. Well, there we go. Now that we have the whole income statement situated, we can start filling the kind of different pieces. We know that our LTM EBITDA is this 500. Our margin is just going to be our EBITDA divided by our dollar amount. And the prompt, it says that the margin is going to stay unchanged at 50. So we can just set this equal moving forward. And I'll also put in percentage right there. And we'll just paste over this. Paste over this formatting. There we go. For all of the percentages that we're going to have. There we go. For our revenue growth rate, it's assumed that it is 10%. So we're going to have 10% as our revenue growth rate, and that'll stay the same throughout the entirety of the period. To get our year 1 revenue, or our revenue growing, you take the previous period, you multiply it by 1 plus whatever the growth rate is. So from 1,000 to 1,100, we can paste this forward. Our EBITDA is just going to be that margin times whatever our revenue was. We can paste that forward. For our DNA, it says that we assume that it's 10% of our revenue, and our CapEx is going to be 10% of our revenue too. If you were actually filling this out on paper, it might be beneficial to just omit the DNA and CapEx when you're adding them back, just because they're going to cancel each other out. But I'll make note of that again once we get to the cash flow calculation. But essentially what's going to happen is you're going to have this DNA non-cash expense that's going to be equal to whatever the outflow for capital expenditures are going to be, and so they'll offset in terms of free cash flow calculation. So if you're trying to do this a little bit quicker and calculating directly to free cash flow, it might be beneficial under net income to only take into consideration that change in net working capital, because the DNA and CapEx will cancel each other out at 10%. But that's not what we're going to do here. We're going to lay it all out. So we have our DNA, 10% of revenue. We'll take this times our revenue, paste it forward. We'll make this a negative so we can subtract it out. Okay, so then our EBIT is just going to be that DNA plus our EBITDA. And our margin is just going to be that EBIT divided by our revenue. There we go. Our interest expense is going to remain consistent throughout the period, and it's going to be that $2,500 of debt times the interest rate we were given in the prompt, so 10%, so it'll be $250 for each period. Our EBT here is going to be our EBIT plus our interest expense, or less our interest expense plus the negative. Lastly, for our margin, we can just do this divided by our revenue. And then for our taxes, in the prompt it says that we should assume a 25% tax rate. So code that in. And we'll just do our negative tax rate, or our tax rate times our EBT to get our tax expense. Then for our net income, we're going to add the taxes to our EBT. We can paste this over. So now we have the income statement portion of our paper LBO done. And like I said, this is a little bit more complicated than what I'd probably actually do if I was doing it on paper, but this is just to provide some more clarity in terms of what's happening mechanically. But now we can move on to our free cash flow calculation. Starting with our net income, bold that here. We're going to add back our DNA. Then we're going to subtract out any CapEx. This is going to be a percent CapEx. We can paste over some formatting. And then we're also going to take out our changes in net working capital. Then we'll do percent change in net working capital. And so then the end result is going to be our free cash flow. Paste the formatting over. Okay, so starting with our net income, we're going to add back our DNA or subtract out the negative. Our CapEx, we know, is going to be 10%. So this is what I was talking about earlier, where essentially what will happen is your CapEx will just offset your DNA as a part of the cash flow statement. So we'll do our 10% CapEx times our revenue. And so if you see the numbers are the exact same. And so if I was theoretically doing this on paper, it'd be more efficient to not worry about like these two line items. And I jump straight down and I do my net income less my changes in net working capital just to save a few seconds. Because I know that the result of this in any year is just going to be 0 because they're offsetting. But continuing on, now we have our changes in net working capital. On the prompt, it says that it's 5% of our revenue. So we'll assume it's 5%. Consistent forward. We'll do negative 5% times our revenue for each period. 55. This plus the sum of these numbers up here, just the sum of all of these. And this will get us to our free cash flow. It's also important to note that for doing this on actual paper, you can definitely make some assumptions, especially once numbers get a little bit trickier to project. Like for some of the revenue growing at 10% can be kind of complicated, or this is pretty easy at 50%, but if the margin was a little bit more complicated, feel free to round when you're doing it. That'll be helpful and also keep you a little bit cleaner or faster when you're actually getting the calculation done. So now that we have our free cash flow calculated, we can move on to our returns calculations, our returns analysis. So we'll start with our year 5 EBITDA, our exit year. Then we'll multiply that by our exit multiple. That'll get us our TEV at close, which is essentially our sell price, what we're going to be able to sell this company for. We'll put in a formatting. And we'll take out our debt, which is going to remain unchanged. And it wasn't noted in the instructions, but for paper LBOs, you'll almost always assume bullet maturity. So there's not going to be any prepayment of debt. You assume that whatever cash you're able to generate over the period for your free cash flow will be used in its entirety to pay down as much debt as you can upon exit. Next thing we're going to do then is add back in our cumulative free cash flow. And this will get us our EQV at close, which is essentially the dollar to sponsor. So this is how much as the sponsor will actually realize upon exit. So we'll start with our year 5 EBITDA. We'll link that in. So it's going to be the 805. Our exit multiple will be the same as entry. So that'll be 10 times. And I'll format this really quick. Meaning that our TEV at close is going to be, format that correctly. Meaning our TEV at close is going to be that 8,052. Our debt has remained unchanged during the period. Like I said, you're assuming bullet payment kind of at maturity. Our cumulative free cash flow is going to be the sum of our free cash flow in every period, which will be 741. Meaning our EQV at close, or the money that's attributable to sponsors, is going to be 6,294. So the next thing that we'll calculate is our MOIC and our IRR. Starting with the MOIC, just to kind of write out what's actually happening here. It's your sale price, or like your EQV, divided by your initial equity contribution. So what this will look like here is we'll take our 6,000 and we'll divide it by the $2,500 that we had to put in as a sponsor at the beginning. which will get us our MOIC of 2.5 times. There you go. So that's what's happening mechanically there. So we can link over. We'll do the calculation again. Just here, so I'll delete that out so it looks better formatting wise. So it's that equity, the dollar amount that's going to be attributable to the sponsor at exit, divided by what they had to contribute initially. So that's going to be 2.5 times. And typically with the paper LBO, what will happen is you're not going to be able to do a legitimate IRR calculation. So instead, you need to know your approximations. So at 2.5 times, I know that this is roughly 20%. And so you can look these up. They're not that complicated. Essentially, the way it works is 2 times. Take the formatting. We'll have our MOIC, IRR. For the approximate, you'll have 2. Up to 3.5. And so you essentially can kind of piece together where something will sit based off of these approximations. So the IRR for 2% is 15, 20%, and so on, up to 30. And so you kind of have the ability to piece together where something would be. So here in this case, we have 2.5, which is nice because that's clean. We know that that's 20%, or if it's exactly 2.5, it's 20.1%. It's exact. But even if you don't have it exactly, you still have the ability to piece together kind of where it would be. So for example, if something was 2.2 times, I could say, all right, I know that 2 times is 15. I know that 2.5 is 20, meaning that this has to be somewhere between 15% and 20%. So I'd probably say, like, if I had to do an approximation, I'd say like 17% or something like that. But you essentially have the ability to back into or piece together what a IRR and MOIC would look like based off of kind of these approximations. So this is important to know for once you get to your returns analysis and kind of your ending calculation of where is my IRR going to sit, knowing that this is the MOIC. But yeah, that's kind of it, broadly speaking. It's a lot more simple than the earlier kind of full 3-statement builds that we did, but this is kind of what it'll look like. And typically when you're doing these on paper, you'll combine what I'd call here steps 3 and 4, which is just instead of doing a full income statement build out into the free cash flow calculation, you can kind of combine these together into one complete step and just call it free cash flow calculation. But yeah, broadly speaking, that's it. It's still in line with kind of the basic steps that we've talked about in the past of your transaction assumptions, your sources and uses, your free cash flow calculation, and then you don't have a full debt schedule build out, but instead assume bullet prepayment at maturity. Then you're able to calculate your MYC and then use those approximations to kind of back into a reasonable IRR. Yeah, that's going to be all for the video. Let me know if you have any questions in the comments.